Kia ora. Merry Christmas. Hope you all had a good Christmas. And all the best for the New Year's coming up. Hey, look, I'm just going to put together a few bits of information in preparation, firstly for the test for when you come back. So I'm going to cover off the various topics that you'll be tested on. So the first one will be inventories, which is the standard IAS 2. Okay, and basically it covers inventories. That's the what. Why we do it is because inventories are a current asset until they're sold, right? So it's important that we've got the correct value either in the income statement and in the balance sheet, right? So there's a few things. If we overstate the value of inventory on hand, we're going to understate the expense cost of goods sold, right? Which will have an effect on our profit. So we'll be overstating profit, and we'll be overstating the assets and therefore the net worth of the business, right? And vice versa. If we understate the value of the inventory at the end, we're going to understate the profit, understate the assets, and understate the net worth of the business, right? This has also got some tax implications, right? So if you're understating your profit, you're understating your tax liability, and if that were to be picked up, there could be consequences in the form of penalties and tax and arrears and those sorts of things, right? Okay, the NZIAS2, it gives us some guidance really on how to get things right. Various businesses have different ways of managing their stock, right? So the more stock you have, obviously, the better systems you're going to have, right? Some service industries, for example, they mainly sell labour and things like that. They do carry a level of stock, but it's not the lion's share of their business, right? So they might be okay just to periodically have stock takes and things like that, right? But obviously, technology nowadays, there's no reason not to have good perpetual inventory systems. Okay, so then it comes down to how do you value that stock, right? Because what you pay for a widget today could be different for what you paid for it last week, and next month you're going to be paying another price, right? So unless we're tracking these individual items, which you might do with big ticket items, which are barcoded and serial coded and all those sorts of things, and you can actually, when you buy and you sell that item and what you paid for it. But if we're buying them en masse and there's 101 of these widgets, we can use a few different methods. You've covered this in accounting concepts, and there's first in, first out, last in, first out, and weighted average cost. Right, so you should have a feel for these, and you should have a feel for roughly how to work it out, or know where to look up how to work those things out, right? Okay, we've tested you previously on this, so we won't be testing you on that in this test, right? Okay, and then also there's a couple of things sometimes where people don't have a lot of stock, but you need to make an estimate of how much stock there is, or what the stock level is at the end. There are some methods if you've given a bit of information, i.e. you've got what the opening stock was, what their purchases are for the year, and then there's the what the markup is, or what the gross margin is. So depending if you know either of those, you can work it out. Okay. So the cost of inventory is pretty straightforward if you buy and sell without adding any value, but it's more complex if you're manufacturing and need to and you need to account for the conversion costs, right? So that's direct labour and the rent for the factory and the foreman and those sort of direct costs that are linked to the manufacturing. Okay, because they become cost of that inventory. Okay, there's pretty good guidance in that standard, and the standard's not that big to have a quick read through anyway. Okay, the key thing, I suppose, is net realisable value. So it's all well and good, but if we've got a whole lot of inventory sitting on the shelves that actually is not even worth what we've paid for it, we need to obviously reflect that loss that we've incurred, right? So we're going to do an exercise on that in a second, all right? Just before I do that, I just wanted to confirm with you that around periodic and perpetual, how that looks. Okay, so if somebody just does a periodic stock take, right? When they first buy the stock, let's say they spent $20,000 money coming out of the bank, and they recognise that as purchases, all right? So that would be the journal entry in somebody who keeps a periodic stock take, right? Because they're going to say, let's say their opening stock was 0 anyway, okay? Right, so that's not a big deal. Right, so that's currently how they stand. They've got $20,000 worth of purchases, all right? Okay, so let's say they don't trade at all. They do a stock take. They should still have $20,000 worth of stock. They do a journal entry to show that the stock is still on hand at that point of time, and there it is. So that's the journal entry, right? So they've made no money. We know that, okay? Because they haven't really traded yet, all right? So that makes sense. So that's how they would account for it, okay? Whereas the person has a perpetual inventory system, when they spend the money on stock, it goes straight to being a current asset, all right? And it only moves from being a current asset to a cost of goods sold when it's actually sold, right? So let's say that this is the same, right? So okay. Right, so let's say they trade a bit and they sell 10,000 worth of product for they trade on. They sell $10,000 worth of product for 20,000. So they sell $20,000 worth of stock. All right, that money goes into the bank, so that would zero that one out. Okay, so that would be the journal entry there. Okay, and the markup, let's say, was 100%. So $10,000 worth of product would go to there, and that would reduce by $10,000, leaving $10,000 in there, right? Okay. Whereas with this other entity, okay, basically, let's say that this was their closing balance last time, okay, and this time they do exactly the same thing, right? They make $20,000 worth of sales, all right? So $20,000 worth of sales. The money just goes in the bank. 200, 20,000. Money just goes in the bank, so their bank account goes to 0 too. Okay, 20,000, 20,000. Okay, they would say that their opening inventory was 20,000. They have sold $10,000 worth of, no, they haven't bought any more. That's right. Okay, and their closing stock, they do a stock take, and the stock take should come to 10,000, and they would have this closing stock as their formula of cost of goods sold. Okay, all right. Okay, I might as well get around the right way. Okay, so basically they both end up with the same figure, right? Except this one here has the perpetual system where the stock sits as a current asset. This one here, they just take a stock take it at the end of the period. They know what their opening stock was. Okay, they didn't make any purchases. Their closing stock should be 10,000, right? Because I've sold $10,000 worth of product for 20,000. They both end up with the same profit figure. They both end up with the same amount of inventory, and they both end up with the same amount in the bank. All right. So that's just showing you the two different systems. Okay. Now onto the you won't be tested on that. It's just so you've got the background information, right? So net realizable value exercise. Okay, so it's critical that we recognize the stock at the lower of, okay, what it cost us, okay, and that we've been given that, so that's not too bad. All right, so it's the lower of that or what the net proceeds are. Okay, just to give us a bit of, rather than just tell us what the net proceeds are, we can pretty much, otherwise it'd be pretty straightforward. Okay, we need to realize that if we sold this product for 135, that's great, right? But we still have to package it, and which will be a conversion cost, right? We still need to package it, and we still need to freight it. Okay, so that's the amount we're going to get, but we need to reduce it by those two costs that we haven't paid for yet, right? So net realizable value, okay, is going to be sales proceeds less the packaging we have to pay for, less the freight. Okay, all right. Okay, all right. So we can see that net realizable value is higher than the cost. All right. So what the workings will be the lower of, okay, lower of net realizable value, okay, or cost. Okay, so in this instance, the lower is the 120. Okay, right. So this net realizable value for all of these should be the same. Okay, I can see that the lower of these ones is going to be 60,000. Okay, so we've got to do this product line by product line. We can see that the lower of product C is actually the production cost. All right, okay, and I can see that the lower of net realizable value and the cost is the net realizable value. Right, so that will give us that. Right, so therefore, line by product line, I've got the values. The lower of net realizable value or cost. Okay, so if I sum that, okay, that will give me the value of the stock. Okay. Okay. So it's my workings. Okay. And it gives me my answer. Okay. Right. So set out your workings so that probably you can understand it and also somebody else can understand it. Okay. I've noticed a huge improvement in people's worksheets during the last term. Okay. So again, if you set these things up, spend a little bit of time setting them up so they mean something to you, and it's likely somebody else could interpret them. Okay, because if you do make a mistake, it's easier to see where it is rather than the whole thing just looking wrong. I could see that okay, only one line item has been incorrectly calculated, right? Okay, so that's a practice exercise on inventories. It's also a summary. Okay. But the go-to, there's not much in the course booklet on inventories, but the go-to is that accounting standard. It's not a very long standard, and even though inventory is such a huge part in some businesses' financial accounts, the standard is relatively straightforward. Okay, all right, I'll leave you to it, and I will be posting further information on some of the other topics that you'll need to get on top of for test 2. So yeah, I'll keep you posted.